Hey, what's up, everybody? Welcome to the live stream. If you're new here, this is known as Keith Condensed at a later date. But I would love for you to join me on the live stream where I give away half an ounce of silver. Tonight is actually the night that I will be giving away half an ounce of silver to the person who has the most K-Coin. If you wonder what K-Coin is, come to the live stream, figure it out. It's a little bit complicated to explain it on an actual video. But anyways, today I wanted to get into a question that I got from Jasmine Soto. And her question was, hey Keith, I have a question. What about investing 15% into ETFs and the rest into companies? What do you think about this strategy? And for me personally, I when someone asks me about a strategy, I'm kind of like, test it out, like see if it works, right? I have like, first of all, I would say that there's probably not enough context in this actual question or in this statement to be like, is this good or is this bad? First of all, my first question would be 15%. You say 15% into ETFs. What ETFs are you specifically looking at? There's a ETF called VOO, which is the Vanguard S&P 500 ETF. That's going to expose you to every single S&P 500 basically company based upon market cap or whatever it is, basically to mimic the S&P 500 as best as possible. There's other ETFs that are going to be strictly to track a certain industry. For instance, like Gamer, which is only a gaming stock ETF. So it only tracks companies that are involved in gaming, basically gaming companies. So the risk that you might see with only a 15% ETF could vary quite a bit. And then second of all, how many companies are you looking into invest into as far as the rest into companies? Are you planning on only doing like 5 or 2 or 10 or 30? Or what's the limit that you have placed on that as well? So those would be two questions that I have about your strategy that probably you should work out before you actually attack the strategy. However, I guess when looking at a strategy like this, I ask myself, will this strategy, or do I think that the strategy, or is there a way for this strategy? Have I seen this strategy beat the S&P 500 in years past? And so does that make it, maybe it would still be possible into the future to beat the S&P 500. If it's not possible to beat the S&P 500, so to get like an 10 to 11% return year over year on average, then maybe it might be better for you just to go like to a 90% S&P 500 ETF and a 10% bond and let it run like that instead of picking up any single stocks in your portfolio. Another approach could be for you to try out this strategy, 15% ETFs, 75% single stocks basically. And if it doesn't work, say you're like, okay, well, I'm going to try it out for the next 2 years. If it doesn't beat the S&P 500, then you're like, okay, well, I tried it out for 2 years. I decided that I was going to leave myself with 2 years to see if it was going to work. I didn't beat the S&P 500 the last 2 years. And so you know what? Now I'm going to change my portfolio again to basically only expose myself into a VOO with a 90% bond fund or whatever you're looking for. But just to change it up so that way you are at least getting at least market growth. Because yeah, it's possible to beat the market growth, which would be S&P 500 average. But I mean, when it comes down to it, if you're not beating the S&P 500, you're leaving a heck of a lot of money on the table. And I think that's what it really, really comes down to is, are you going to be beating market growth? And if you are, then great. Like, I don't see a problem with running your portfolio like that. Just know that you'll be exposing yourself to more risk by only having a certain amount into ETFs, because within those ETFs is going to be a huge basket of stocks. It's going to be a ton of stocks in there, so you're going to get a lot of diversity in most ETFs, whereas just exposing yourself into single stocks, you might do 10, which is going to make your portfolio, just by the nature of it, more risky, more volatile. So that does come with upside, though. It can come with upside, but also it comes with downside. So keep that in mind moving forward as you look to expose yourself onto that strategy. I would say is test it out. If it works, if you're getting better growth than what the S&P 500 is, then great, good for you. But like, if not, then consider changing it. So I would set a time limit on how long, or for me personally, what I would do is set a time limit for me and be like, you know what, 2 years, maybe a year, maybe 3 years, maybe 5 years, and be like, you know what, after this point, I can no longer like lose more than what the market growth is. And so, hey, I got to go ahead and change my portfolio so that way I can capture that market growth. That way, when I come to retirement, or when I come to buy my house, or when I come to 20 years from now, I get that big lump sum of cash that I was actually planning on having. So there is more risk, like I said, that does come with this kind of strategy. But I mean, it does happen. And with that risk can come with that bigger upside. So keep those factors in mind as you look forward into this strategy. Anyways, guys, I would love to hear your thoughts, comments, criticisms in the comments, or if you're in the live stream, in the live chat, it would be awesome. Would this be a strategy that you would look for exposing yourself to in your own personal portfolio? Or do you try to keep it more safe with like only exposing yourself in the ETFs, maybe 80% into ETFs, maybe another 10% into a lot of single stocks, and then exposing yourself into bonds? Or do you not prefer bonds? Or however you run it, I would love to hear your thoughts, comments, and criticism down in the comments. Anyways, guys, it has been real. Thank you for watching. I really appreciate it.